You might no longer get the mortgage because of which credit score your lender runs, not because your file changed, but because the mortgage industry just opened a model war. In July 2025, the Federal Housing Finance Agency cleared the path for VantageScore 4 to be used on Fannie Mae and Freddie Mac mortgages, and FICO fired back with a new model called 10 tons that it says predicts defaults much better. Who wins? Who gets crushed? Stick around. The answer could change whether you lock a rate this quarter. This is a deep dive on the 2026 credit score reset. The policy moves, the industry scramble, and exactly which consumer groups gain or lose depending on whether a lender picks VantageScore 4 or FICO Score 10 tons. By the end, you'll get two practical playbooks, one for lenders and brokers, and one for consumers who need to protect mortgage eligibility in the next 30 and 90 days. Quick disclaimer before anything else, this is educational only, not legal, tax, or financial advice. Check with your lender or licensed professional before you make mortgage decisions. Data and policy references are accurate to public releases through the 8th of January 2026. On the 8th of July 2025, the FHFA officially allowed lenders to use VantageScore 4 for mortgages that will be sold to Fannie Mae and Freddie Mac. That unlocked an alternative path into the conforming mortgage market, which finances the majority of U.S. purchase mortgages. The Credit Score Competition Act and long-running policy arguments wanted competition and models that better incorporate modern data, like rent and utility payments. The enterprises immediately published guidance and began delivering historical VantageScore 4 scores to approved market participants so lenders and investors could model the effects before switching. Policy was only the first step. Operational adoption is another. The tri-merge credit file structure stayed in place, and the industry had to reconcile how tri-merge reporting and disclosure, automated underwriting system behavior, and investor disclosures would change. That meant November 2025 disclosure updates and a lot of back-end plumbing for lenders. If you think this is a technical sideshow only compliance teams care about, think again. This change rewrites who qualifies for the same loan. Not long after the FHFA move, FICO accelerated promotion of FICO Score 10 tons. FICO published an analysis asserting 10 tons decisively outperforms VantageScore 4 at predicting mortgage losses. Two headline features in 10 tons are trended data and refined treatment of account balances and recent delinquency risk. In plain terms, 10 tons looks at patterns over time rather than snapshots. FICO also announced a new direct licensing pricing approach aimed at getting lenders lower per score costs and letting FICO bypass some traditional bureau markups. FICO's numbers were framed as very favorable to 10 tons, but those are vendor-released performance claims. Independent third-party verification and academic peer review take time. Still, markets reacted immediately and lenders, investors, and rating agencies paid attention. Once score choice became possible, the credit bureaus did not sit quiet. Equifax, Experian, and TransUnion moved to protect their market positions with competitive pricing and promotional offers for VantageScore 4 licensing. Some public reports describe discounts, temporary free offers for lenders, and incentive programs to keep existing score supply contracts intact. Trade press covered tension and rumors that bureaus were trying to block FICO's pricing play. Now, this is not just academic for lenders. Score licensing terms and per loan economics can affect pricing engines, margins, and even the willingness to accept pipeline loans if a model change increases buybacks. Are lenders going to run both scores on every borrower? Some will. Others will pick a model based on portfolio strategy, and that split creates fragmentation across the market. That means two identical borrowers could get very different results at neighboring lenders. Who benefits? VantageScore 4 emphasizes alternative data channels and is more likely to incorporate verified rent, utility, and telecom payments if those data are reported through the bureaus or approved third-party services. If you're a renter with a thin credit file but with consistent rent payments now being reported, VantageScore 4 often raises your score relative to classic FICO or even 10 tons in many cases. Early signals from lenders who tested the historical VS 4.0 delivery showed renters with documented rental payment histories moving into higher score bands under VS 4.0. Imagine two applicants with a single credit card, limited trade line history, and 24 months of on-time rent reported to the bureaus. Under VS 4.0, that rent history can bring their score up several points, potentially enough to move from a subprime bucket into a near-prime bucket for underwriting. Lift is not universal. The benefit depends on whether rent is actually reported to the bureaus the lender uses and whether the lender has chosen VantageScore 4. So your rent matters only if it's reported in the way the lender checks. Who loses or faces uncertainty? FICO 10T's strength is trended data and nuanced treatment of balanced behavior, so borrowers with buy now, pay later activity, especially arrangements reported as open zero balance trade lines or recent collections, may receive lower scores under 10 tons because it pays more attention to ongoing revolving behavior and payment patterns over time. Some recently delinquent borrowers who had short-term hardship resolutions may be penalized more aggressively by 10 tons' predictive logic, even if they now have several months of on-time payments. Subprime borrowers are a mixed bag. Those who rely solely on BNPL or short-term retail credit without long-term trade lines might be scored lower by 10 tons and sometimes higher by VantageScore 4 if alternative data is present, but it's file score dependent. The core takeaway is the model choice creates asymmetric impacts by profile. Operational headaches matter too. This change touches automated underwriting systems like Desktop Underwriter and Loan Product Advisor. AUS vendors and investors need to rerun or recalibrate decision rules against VS 4.0 and 10 tons to ensure loans still meet eligibility. Lenders must validate tri-merge outputs, ensure dual score reporting is handled correctly, and confirm AUS responses for each model. This creates a timing problem for pipelines. If you pull credit under classic FICO during pre-qualification and the underwriter later uses a different model for delivery, you can see pricing or eligibility shifts between rate lock and closing. If you're a broker, running a single score pull might no longer be enough to find the best deal for your borrower. Parallel score checks are becoming a competitive advantage. For lenders and brokers, here's an urgent triage plan you can follow right now. In the next 30 days, confirm which score or scores your secondary market buyers. Accept and ask Fannie and Freddie channel partners whether VantageScore 4 is accepted for your product line. Start parallel testing by running VantageScore 4 and 10 tons on a representative sample of live pipeline files to measure upstream AUS and pricing changes. Validate tri-merge data feeds and vendor mappings, and ensure your loan origination system supports multiple score inputs and stores them for disclosure. Communicate with originators and brokers about potential price and eligibility differences, and request dual pulls where feasible. Over the next 90 days, adjust product matrices and pricing engines to account for distributional impacts you observed in the 30-day window. Decide on a model policy. Do you standardize on one model for pipeline consistency or run both and optimize per borrower? Document lift criteria, update disclosure templates, and investor files with model flags so buyers know which score generated eligibility. Train underwriting teams on typical profile shifts under each model and disseminate playbooks for exception handling. If you're applying for a mortgage, here's what to do in the next 30 and 90 days. In the next 30 days, ask your lender, before they pull credit, which score and bureau they plan to use for underwriting and delivery, and try to get that in writing. Freeze any automated applications or new financing that could add BNPL or new trade lines you don't want on your file. If you're a renter, start verified rent reporting immediately with a reputable vendor that reports to the 3 bureaus. This can be a game changer under VantageScore 4. Run your own tri-merge report through paid services or certain free options and dispute clear errors now, because disputes can take time. Over 90 days, if your lender is using VantageScore 4,